Well, the U.S. added far more jobs than expected last month, about 350,000 jobs, almost twice what was forecast. So what does that mean for the Fed? And what can we also expect on this side of the border from our own jobs data out next week? Well, let's bring in Derek Holt, Vice President and Head of Capital Markets Economics at Scotiabank. Derek, thanks so much for joining us this afternoon. Always appreciate it.
It's a pleasure. Thanks, Jacqueline.
So looking at this jobs data out of the U.S., I mean, we have been surprised again and again, but with the Fed perhaps on the brink of maybe cutting rates, it seems like they're more than just talking about it at this point since this last meeting. They're thinking about it a little bit harder, maybe not in March, but maybe after that. Does this change that, though? Does this push things out even further?
You know, to be honest, I did not like Chair Powell's press conference when he delivered it. I thought he did an about-face compared to his comments at the November 1st press conference when he said that if you get further upside growth, GDP growth relative to potential, and you see evidence that the labor market is no longer coming back into balance, a direct quote, then he will have to tighten further. And then he changed that up this past set of communications and did an about face and talked as if growth, it doesn't matter, jobs, they don't matter. I think he's going to have to take that back. I think going forward, he's going to have to talk much more carefully. We won't hear that in his Sunday interview because he recorded it before the jobs numbers, unfortunately. But on balance, I think you've got a Fed that's looking at Q1 growth that with nowcasts of 4 or 5%, jobs on a fire in this market, 350,000 jobs with upward revisions and still no sign of a slowdown anytime soon. I think he can't talk rate cuts for a long period of time. The way in which I would balance that out is push him out and push him lower. Yeah,
you know, that jumped out to me as well when he was talking about economic growth. And I actually I want to read that snippet because he said, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. We look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down. And it really jumped out to me. Can you do both? Can you have a strong labor market the way that it is in the U.S. and can you have a strong economy the way that it is there and have inflation come down all the way to that target?
It requires a lot of heroic assumptions in order for that to happen. And I think, I mean, GDP is not what they target, obviously. We all know that. They target the dual mandate, price stability and full employment conditions, and they're not achieving that on the price stability side of the picture, and the employment side of the picture keeps growing at an overheated pace in this kind of environment, growing jobs in the U.S. economy at a pace that is beyond the ability of the economy to absorb it. And so this was a real dent to the narrative he was pushing before these numbers, that the job market is showing these signs of rebalancing. And then we saw job vacancies pick up and jobs with positive upward revisions really smash expectations. And so I think he's probably at the margin regretting taking back his direct quote in November, and I'll read it. Evidence of growth persistently above potential or that labor markets are not coming into balance could warrant further tightening. Why didn't he say that again this time around? There's no reason for the Fed to be talking easing anytime soon. In fact, when we get the GDP numbers for Q1, it'll be 5 or 6 days before the May 1st FOMC announcement. It'd be really, really awkward optics if you have a very strong Q1 performance and you turn around and cut. And so I just can't see that happening anytime soon.
Speaking of GDP data, not quarterly, but monthly data, we did get some data for Canada this week. It wasn't it? Now I'm going to blur my days together because it was a busy week. But in any case, that data showing that the Canadian economy was growing at a faster pace than expected as well. And I just wonder how much of that do you think is coming from the strength in the U.S.?
It's like our best big brother or sister. It's our best friend in the world in this kind of environment. As long as the U.S. economy is growing at this kind of a pace, it's a good safety blanket for the Canadian economy because we export so much to them because of the degree of integration between our capital markets. And so I treat that as a very strong positive, but I also think there are idiosyncratic risks at home that still keep hike risk alive in Canada. And I don't think that we can dismiss that at this point.
When you're looking ahead to and it was this week. It was the 31st. So I'm not crazy with my memory here for the data. When you're looking ahead to next week, we're going to get some more data on the Canadian labor market in two parts, because you're looking out for some wage data that's coming out at the start of the week.
Yes, on Monday we get the wage settlements data for the latest month, the contract settlements on collective bargaining exercises, and they were already hot before. I'm expecting an even hotter number, multi-decade high in terms of the wage pressures that we're dealing with, and institutionalizing those wage pressures at a multiple of the Bank of Canada's 2% inflation target for years to come. This is a key differentiating factor in Canada relative to the circumstances facing the Fed. Roughly 1/3 of our workforce is unionized versus 10% in the US. We're still at a very early stage in terms of collective bargaining. We are institutionalizing rapid wage gains for years in these contracts, and we're only scratching the surface in terms of those collective bargaining decisions. In fact, in Ontario alone, over the next 2.5 years, you've got 1 million workers whose collective bargaining agreements will be expiring. And guess what they're going to be doing? It's like pro sports. You got to get a better deal than the prior person, guy or gal.
Right.
And so I think they're going to see that persistent upward pressure upon wages at multi-decade highs, and that's going to make it extraordinarily challenging to achieve 2% inflation, especially since, very quickly, remember, these wage gains are being given to a workforce that is not producing more. It's producing less per hour worked in a serial fashion.
Yeah, you know what? Something did jump out to me from one of your notes this week as well, Derek, and it was on per capita GDP and on the influx of people, immigration to this country. But you were talking about it being in multiple phases in terms of the effect of that. And I just had to pull that out because I hadn't thought about those second or third phases. Can you just give the sort of Cole's Notes version of it?
Sure. Okay, sure. The first round effect is you have this big surge of arrivals into the country that are struggling to find jobs, start businesses, find a place to live, maybe get some mode of transportation, buy stuff to go in the home. They're gradually getting integrated into the economy. And so in that first phase, it's entirely possible that measures like per capita GDP suffer because you're getting more of a people influx than you are an output gain in the short term. But the second, third, and fourth round effects could turn that around in the other direction. And so I find some of the commentary that's ringing alarm bells on per capita GDP has some merit to it because it's accompanied by very weak productivity, but some of it almost sounds like it's getting a little bit too political and too extreme. We have to give this experiment more time to unfold in a multi-year fashion. And that's been the story of immigration in this country all along. It takes time to integrate new arrivals. We're not as good at it as we should be or as we would like to believe, but there will be a dividend coming for years to come.